Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Pierre Debbas, managing partner at Romer Debbas, a boutique real estate firm located right here in New York City. And we're going to talk about what the drop in mortgage demand means for the housing market. It is great to have you back at market site with us.
Thank you, Jill. Great to see you.
Mortgage apps, lowest level since 2018. We have year over year, 90% drop in rate and refinances. What does this drop mean to the housing market?
So the refinance activity is going to come to a screeching halt because at the end of the day, who didn't refinance their mortgage in the last 3 years? And with rates being, having increased over 200 basis points since the beginning of the calendar year, there's going to be no activity in that segment of the mortgage market. Now, for the purchase market, again, we got spoiled by historically low rates hovering in the 2 to 3% range for what at that time was a 30-year fixed rate was, anywhere from 2.7 to 2.9%, which if you think about it, it wasn't long ago. We're talking 6 months ago we were seeing that, but it was an astronomically low number in comparison to historical figures. You will see a slowdown, obviously, in mortgage activity because, I think, quite frankly, the ripple effect that this will have on the housing market is that you're going to have a drastic slowdown in activity, not necessarily a drastic decrease in pricing. So pricing will certainly adjust because, clearly supply and demand dictates pricing. But at the end of the day, we still have a tremendous supply shortage of housing, regardless what we do with rates, regardless what we do with policy. So that's why I'm not so pessimistic in terms of the impacts on pricing. However, you'll start seeing more cash deals. You'll see slower activity. Slower activity will result in a continued decline in mortgage applications. But I do think that pricing will maintain some level of stability.
When do you think we might see some normalization with supply and demand and getting inventory back on the market?
Well, the problem with inventory is that you have to create it. And
right.
What's not being discussed now is how to create more housing. How do we build more housing? And then at the same time, we just talked about the refinances. If you own a home, you refinance and you locked in a 30-year fix at 2.8%. What's going to be the impetus for you making a move, right? There's really only two reasons in this market you would sell. A life event where you have to relocate states or you need more space or something along those lines, or you're bearish in terms of the future of the value of the housing market and you want to capitalize on the appreciation and take out your gain and take it and go. That's really it, because if you're going to sell for any other reason, you're going to sell and then pay double the cost for your debt service than you're locked in now, which is a huge disincentivizer to trade, to move, to relocate anything. So I think that we're going to continue having the supply issue for the foreseeable future. So with that supply issue is where, even if demand drops by half, right? Like Jill, a year ago, I think Fannie Mae had a stat that we were about 5 to 6 million homes short of current demand levels. Even if that drops by 50%, right? Which it likely will, but you're still millions of homes short of demand levels. So at the end of the day, until we figure out how to build more housing, we're not going to address this problem.
Right. Well, affordability is an issue as well. I mean, if you are in the lower end of the market or first-time home buyer, I can't even imagine the struggle that they have to go through because, of course, rents are so high in it too.
Entry-level buyers may be axed out of the market for their lifetimes, for this generation. And it's a shame because I don't think that's the intent of rising interest rates, trying to temper the housing market, because the entry-level buyer is the one who's going to suffer the most by far. If you look at it where you compare the 2.8% interest rate to a 5.2% interest rate, how that affects a monthly mortgage payment. For the high-end market and affluent buyer, they can stomach that differential, right? Maybe they'll negotiate for somewhat of a price reduction that compensates for some of it, and they'll live with the differential because even at 5.2%, we're still at a historically low level.
Right.
Entry-level buyer they're axed out. They're done because at the end of the day, if your mortgage goes from $1,100 a month to $1,800 a month, who does that impact the most? That delta, that $700 difference. I compare it to gas prices. You go to the tank, you fill up your gas. It's $30 to $40 more per refill, assuming you fill it up once a week. You look at the gas pump in dismay. Maybe you say a couple unpleasant things to the gas pump. It's not changing how you live your life on a day-to-day basis. The same thing with the housing market. Those people are changing how they live their lives on that $200 additional month for gas. Same logic applies to housing.
Right.
And I think that's that's my biggest fear in how housing's being handled right now, in the fact that the person who's going to be suffering the most is not the person that should be suffering the most.
Right. Well, kind of always plays out that way, doesn't it?
Yeah.
What about the impact of the higher end of the market? Any change there?
You know, so the higher end of the market, there's such a high level of cash activity there. So you know, you're going to still see those properties move. And then what's been fascinating over the last 2.5 years is the amount of wealth that was created. You know, we had the largest growth of wealth in the country's history during a global pandemic with severe lockdowns and people and companies learning how to work remotely for the first time in world history, right? It doesn't add up, right? Nothing makes sense. How was so much wealth created in such a tumultuous time? So who prospered the most from that? The demographic could be buying in the high-end market. So I don't, you know, again, I do forecast a slowdown across the board just because this wave of activity and, you know, how hot the market's been and the price appreciation cannot continue. But, you know, the high-end market probably is going to, you know, remain rather strong.
What about commercial real estate owners and investors, right? They have to deal with inflation, cost of materials, labor shortages, and also the cost of labor. There's just increased costs across the board.
Right.
How's the commercial market being impacted?
Well, you got to look at it from sector to sector. So, multifamily market has been doing extraordinarily well because we're talking about people being priced out of the housing market, which has only increased rental rates. So that's going to maintain, you know, probably a steady growth over the next several years. Office sector is completely up in the air. Nobody knows. You know, the office sector, you know, with this whole working from home, you know, we handle a fair amount of commercial leasing in our law firm, and we're seeing activity all over the place from companies downsizing, companies going under, companies seizing an opportunity to take on more space because there's significant discount. Sublet activity is rampant everywhere because there's just movement, right? There's not necessarily demand, there's movement. At the end of the day, we all know that office will never be as strong as it was pre-pandemic because this has taught us that we can work remotely, and everybody's shown you that, and companies will take advantage of this in terms of reducing their overhead on the real estate space. So I think office is going to be a tough one. Retail was in a precarious position before the pandemic. You know, like we're here in Times Square. You know, when do you remember this high volume of vacancies? And what's going to fill up these vacancies? Here you have maybe tourism and, you know, the workforce and locals to take into consideration. Business districts rely predominantly on the workforce coming. The workforce isn't in, you know, two-thirds of what it used to be. You know, that's going to suffer. That's going to continue suffering retail. So you compound all that with reduction of income and increased expenses.
Right.
It's almost a perfect storm. You want to develop. Good luck getting lumber. Good luck getting materials. Good luck getting, you know, laborers. It's very difficult. So real estate, like any other, you know, segment of the economy, is grappling with the supply chain shortages and labor issues that, you know, we have.
And it was recently announced residential real estate firm Matts & Katz is joining Romer Debbas. What's it going to allow the firm to do?
Yeah, so it's really exciting news. We just broke the news yesterday. So our firm, as of today, was about 25 attorneys, and our firm focuses on all aspects of real estate. You know, predominantly focused on New York City and throughout the country with commercial purchase sale, finance leasing development, and residential purchase sale, finance leasing development, and also obviously very active real estate related litigation practice. Katz & Matts focuses exclusively on residential purchase sale and residential banking. And there are about 12 lawyers. So this takes us, I guess, from a small firm level to a mid-sized firm level. What the beauty about it is that what people never realize about the residential practice in New York City is all the verticals that spin off of it. So when we started the firm, you know, our focal point was the New York City residential practice with a niche in the high end and foreign markets. And we built off all these practice areas off of that. Our litigation practice, our banking practice, our commercial practice, and nobody realizes how much spins off of that. So now by bringing on their focus, which is on the residential market, it only helps us grow those verticals even more with a tremendously high ceiling. So it's a super exciting moment for us. We're bullish on the market still. You know, given all the turmoil that's taking place in the last couple of years, you know, we always thought there'd be some great opportunity, and this was one that, you know, luckily, I got to say, fell in our laps, and we couldn't be more happy about.
Well, that's awesome news. Great to have you back in studio. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.